Hello, let's take a look at our beloved widget cash flow model and see how it would benefit from project financing. And by project financing, I mean we borrow some money on which we'll have to pay some interest, and we get some drawdown or have to pay back some principal. Let's show drawdown as a positive cash flow and principal payments as negative. And we'll say this is our loan drawdown or principal. And then we can talk about cash flow to equity. So for example, let's say we got a loan, someone were going to give us $1,000 for this project, and it was interest only, 20% per year, so our interest would be a couple $100 a year. We'll come back and follow the modeling rules later. And then at the end, we were going to have to pay back the principal amount. How would that affect our cash flow to equity? Well, before I incorporate this new column that I just added, we have a 1368 NPV and a 51% rate of return. But if I'm going to reflect these interest expenses, then my before-tax cash flow needs to include them. So I'll add that in. Copy, paste. We went from 51% rate of return down to 33% rate of return from a project perspective. Now, our primary interest is not how the project does as much as how the equity does. So let's look at how the cash flow to equity would change. So in that first year, instead of having to come up with $1,400, we'd only have to come up with $400. And then if I copy that down in subsequent years, the cash flow to equity would look just like the net cash flow to the project. But keep in mind, this is now burdened with the $200 of interest. In the last year, we'd have to pay back the principal amount. So while the project is seeing a positive 600, equity has to pay back the full principal amount, so it sees a negative 400. So what would the net present value and rate of return look like for the equity? Copy, paste, see if we need to fix any cells that weren't absolute references. Okay, so while the project is only 33% rate of return, the return on equity is 160%. Fantastic. Project equity. So that's the thesis of why we might want to do some project financing. We could put rules around how much we could borrow, what our cumulative cash flow could be, kind of design it like a revolver. But for now in this video, I think let's just focus on how to calculate the interest and the loan drawdown and principal, so that we can find the cash flow to equity. What I've described so far is an interest-only loan. We can talk about the loan amount and the annual interest rate. In this case, the loan amount was $1,000 and the annual interest rate was 20%. So I'm going to build a loan table over here that we'll use later. We would have a beginning balance, which in our case is 0, and then any interest that we paid, which let's say that's the beginning balance times the annual interest rate. I'm going to make that negative since it's an outflow. And then any change in principal or drawdown. So I'm just going to copy those labels. And so in this times 0, it would be, we'd have a positive cash flow of the loan amount, and that would get us to an ending balance, which would be the beginning balance plus any drawdown that we took, less any principal that we paid. The beginning balance of the next period is just the ending balance of the previous period. The interest payment, which we said was the beginning balance times the interest rate, we can copy down. In this case, we don't have any loan drawdown principal, and we can copy down our ending balance. It's still the beginning balance plus any drawdown less any principal that we paid. Now we're in a position to copy these all the way down until the last year when we need to pay back the loan. Now, had we made any principal payments, this beginning balance might be different than $1,000, different than the original loan amount. So I want to just refer to that negative, and that gets us to an ending balance of 0. So this is a quick and dirty interest-only loan, but it sets up our columns to tie back to the model. So interest, instead of calculating it in here, going to refer to the loan table that we just created. Copy, paste, copy, paste formats. I'll go ahead and get these while I'm at it. Paste formats. So now our interest is looking at our loan table over here. And then our loan drawdown needs to do the same. So I'm going to say equal this, copy, paste. And now we have a loan table that allows us to change the loan amount and the interest rate. So let's make those inputs. Let's also consider what was really an input in our loan table down here. Beginning at 0 makes sense because at time 0 we haven't taken out any loan. After that, everything is a calculation, so we're okay with the modeling rules here. All of our interest is the same formula copied up and down. That's nice and clean. Our beginning balance is the same formula copied up and down. That's nice and clean. It's this loan drawdown or principal that bothers me a little bit because I've hard entered a formula here to say we're taking out the loan amount in period 1. I've hard entered some zeros here in the intermediate steps, and then in the final step I've said we're paying off the loan. Let's add another input and call it loan term and set it to 4. And then we can come down here and say if the year over here equals the loan term, absolute reference, then it's time to go ahead and pay back whatever balance we have on the loan. Otherwise, 0. So I can copy that up and paste it here. And at this point, we have formulas in all but the first row that would copy down with no changes. So copy, paste, all the formulas work. If you wanted to, I guess you could write an if statement here that said if you were in the 0th period, then use 0, otherwise use this. But if that's the upper left cell in this loan table, then I think anybody's going to look at that before just blindly copying it down. The interest copies down fine. Kind of the same thing with the principal. If the first row on this table says to look at the loan amount and then everything else is a formula that we can just copy down, you know, if I'm coming behind you to look at your work, I'm probably going to look at the first couple of rows and make sure we've got consistent formulas. And then this formula copies all the way down. What does bother me is if I had to get to the last row and I had a formula that was different than the previous row, that might be kind of dangerous because what if I wanted to copy this down to an additional period? So let's say instead of 4 years, we wanted to do 5 years. Now the formulas should work. You say, but there are zeros there. Well, that's because my loan term was 4. If my loan term were 5, then the table automatically adjusts. And now we've considered an interest-only loan. Interest only because the total payment that we're making, interest plus principal, is all interest until we get to the very last period to pay it off. Let's do one where we pay down a little bit of principal as we go, and let's call that an amortized loan. First, I'm going to copy this formula, single quote, paste, and we'll remember that this is our principal portion of interest-only loan. Gosh, when I look back at that, I'm going to say, why is the principal portion of an interest-only loan not 0? Well, it is 0 except for when we're in the last, or when we're in the end of the loan term and we pay off the remaining beginning balance. Next, we're going to count the principal portion of an amortized loan. And then if we want to use our dashboard to differentiate between which one to use, we can. So how are we going to figure out how much principal to pay down such that when we make that same total payment at the end of the loan, then the ending balance comes right to 0? Well, first let's guess. Let's say total payment, and by that I mean interest plus principal. Copy that just for the formatting. And let's say I pay $100 a month, or a year, I guess. This is an annual loan. And so if I'm paying $100 a year, then my outflow is going to be $100, absolute reference, plus the negative of whatever interest I had to pay, because we have to pay that interest first. Remember, we're calculating, in this case, 10% of the beginning balance, and that goes to interest. And if there's anything left over, then we'll pay it to principal. So we'll take this total payment, what's left over after the interest, show it as an outflow, and that's what goes to principal. So in this first month, we pay $50 in interest, $50 in principal, and our ending balance is $450. So next year, I think I said month, I meant year. Next year, our beginning balance is only $450, so we only have to pay $45 in interest. How much will we pay in principal? Well, if the total payment's $100, that should leave $55 for principal. Let's see if it does. Copy, paste, and it does, $55. So our ending balance is even lower. The amount of interest we have to pay is even lower, and the amount that goes to principal is even higher. And so this is kind of almost like a debt snowball, if you will. The more we pay, the less interest we have to pay, and the more goes to principal. Things just get better all the time. And so this following year, we're only paying $33 in interest, so copy paste, we're paying $67 in principal. And then finally, we're only paying $27 in interest, so $73 in principal. But that's not enough to pay off the loan. So how do we figure out how big this number needs to be, how much our total payment needs to be each year to get this to zero? Well, the easy answer for that is goal seek. We could set that to zero by changing the payment and find out that about $132 would do it. So we pay $132, and I'm not showing the pennies, there probably are some. 50 goes to principal, and to interest, and then 82 goes to principal. So our interest portion goes down even faster, our principal portion goes up even faster, and our total loan goes down quickly enough that it finally reaches exactly zero at the end of the day. So we have an amortized loan here. But we had to use goal seek to find the payment. And if we had a dashboard that allowed us to come up here and change our loan from 500 to 600, we'd have to rerun goal seek to find the new payment to get the ending balance to zero. Fortunately, there's a function. It's called PMT, and we can get by with as little as 3 inputs. We need the periodic interest rate, the number of periods, and the initial amount of the loan. There are a couple of other things we could have put in. We could have put a future value, and that would be if there were a balloon payment at the end of the loan. That's a common way to finance a project. And then we could also specify a type of a loan, indicating whether our payment was at the beginning or the end of the period. Let's just take the defaults, and they'll work fine with one exception. We get a negative number. Let me put this back to 500 and see if we get the right negative number, though. So we do. We get the 132, or if I show those decimal places, 131.90. So PMT works, but why is it negative? This bothers a lot of students. We put the loan amount in as a positive, and it says, well, if you've got $500 coming in as a cash flow in your direction, the payment must be going in the other direction to pay it back, so it must have to be a negative. And so that throws us a bit. We'd already accounted for that down here with a negative sign, so I'm going to come back to this. I could either put the negative here and make that initial $500 look more like an outflow, and then I get a positive, or I could just make the whole thing negative. I don't care what you do. Actually, I don't care if you do either one. You could show that as a negative and just do the math more correctly down here. But what I don't want you to have to do is use goal seek every time. So I'm going to cut and paste. And now that total payment will change. So when I change the loan amount to 600, it re-amortizes the loan and gets it paid off by the end. So the principal portion of an amortized loan, assuming that we know what the total payment is going to be this. And look at the difference. In the amortized loan, we didn't even have to check to see if we were in the last period because the principal portion is calculated the same every time. It's just the total payment minus the interest, and the interest is calculated the same on both loans. It's just the beginning balance times the interest rate. the one thing left to do is say loan type. And we could say interest only. I'm just going to use text here. So I'll write an if statement that says if this equals interest only, then we'll come back and get this formula in a moment. Otherwise, we'll come back and get this formula in a moment. Need to add the equal sign. So let's get this formula without the equal sign. Paste. And then get this one without the equal sign. Paste. Copy. Paste. And that would have worked correctly if I had put absolute references on F5. Copy. Paste. And so as an interest-only loan, we're just paying the regular interest until we pay the loan off. But with anything else I type into this cell, with an amortized loan, then it gets amortized and works that ending balance down to 0. Now, this is easy to look at. It's not super easy to connect to a dashboard. So I'm going to do one more thing. I'm going to call it loan type 1 or 2. Going to format that as a general. And so let's come over here and say loan types. If you don't like if statements, you might like this a lot better. Interest only, amortized. And so if it's interest only, it's a 1. If it's amortized, I'll put in a 2. I'm going to copy that, paste the format since that's an input. And instead of saying if that equals interest only, now I'll say if it equals 1. Copy, paste. Now I can do a 1 or a 2. We can clean this up one tiny bit more. Instead of using the if statement, which I think is intuitive to everyone, I'm going to use something new, and I'm going to call it choose. I'm going to use something called choose. So I'm going to choose based on this number, either that first formula that we gave it, which came from right here, or that second formula that we gave it, which came from right here. And now I feel like I'm tied a little bit more strongly. I need to absolute reference that. Tied a little bit more strongly to S5, so I can put a 1 or a 2 in there. You know, before, if I had simply mistyped the words interest only, then it would say, well, that's not interest only. It might be amortized, and it would have gone with the other formula. Now I have to use the 1 or the 2 to make this thing work, and it's guaranteed to do that or that. No misspelling potential. Copy, paste, 1, 2. And so they work the way we want them to. And you know, another great thing about that is if you come up here to developer, insert, if you use a button or a list box or a combo box, your linked cell is going to be either a 1 or a 2. So let's give it a linked cell. And let's just draw, probably a combo box is the easiest here. Let's draw a combo box right here. Now you'd probably put this on your dashboard for the project you're working on. And I would say format control, cell link here. Of course, we're going to 3D shade it. And the input range is here. At this point, we really don't need this 1 or 2. We also don't need the value that was here. I'm going to move that out of the way. So instead of choosing based on S5, I want to choose based on the linked cell. Copy, paste. Boy, that scared everybody, didn't it? As soon as I choose one of these, it'll populate that linked cell with a 1 or a 2. And now we're back in business. So I can get rid of this. It's not even an input. Just going to slide this up here. Move it there. Now, do I need this 1 and this 2? No, I don't. The combo box combo box looks at the range. I don't really need that title, but it sure is helpful. The combo looks at the linked range and knows that the first one is a 1 and the second one is a 2. So we've done a few things here. We have learned how to add interest if we're paying interest. And I probably should have said at the beginning that this is our loan table. If we have interest in a loan table, then we've learned how to add that to our discounted cash flow so that our after-tax net cash flow, even for the project itself, shows the interest costs, because we need that to get the taxes. And then the equity is going to get the benefit of that initial loan that we take, and it's going to have to pay back that loan over time so that we get a different cash flow for the equity than we did for the project. Might come back and do some critical thinking about those two comparisons. And then we found two different ways to amortize the loan, either paying only the interest until we pay the loan off, or amortizing the loan so that there's no big payment at the end, that each year the payments are the same. I never actually showed you that, but let's prove it. This plus this. Each year it should be 158.28, and it is. And then we learned how to use an if statement to choose one of these two formulas to control what type of loan it was. But then we got a little bit more elegant and used the choose statement, choose function. And the great thing about the choose function is it expects a 1 or a 2, which fits really nicely with 3 different controls that we looked at from the developer tab. So hopefully if you want to work project financing into your team project, you are ready to do that now. Let's check one thing, and let's learn a little bit about project financing. So if I'm doing that, I could look at the project economics, or economics from an equity standpoint. I look at interest only or amortized, and so let's say 1 or 2 on that. I'm going to copy these down just so we know. Alt HAR. I'd like to see how the net present value of the project compares to the net present value from an equity standpoint. So those are outputs. You can tell I'm headed toward a data table here. Couldn't let a video go by without a data table. These are inputs. And how would I complete that one? First I need to say that this is NPV. I'm going to want to turn around and do the same thing for rate of return. And for rate of return, I'm going to look here and here. So let's do some critical thinking now. So data table, is that a row input cell or a column input cell on this one? Well, my inputs are in a column, so it must be a column input cell. And my inputs are going to tell me what type of loan I have. So we'll go with that. And we're looking at NPVs, so let me make those currency. And then let me do the same thing for rate of return. Data table. By the way, I didn't say it, but I selected enough cells and only enough cells to get the formatted cells. Column inputs or row inputs? Inputs are in column, so it's a column input. And the inputs are the loan type. So the column input cell is the loan type. And then we'll come back here, Alt HP for percent. Now let's see how project financing affected our metrics. The project itself always had a lower NPV and a lower rate of return than our equity investment did. So in every case, by leveraging our equity investment with a loan, we did better. The NPV went up in every case, and the rate of return went up in every case. Now let's compare the interest-only loan to the amortized loan. The project NPV liked the amortized loan better, both from an NPV standpoint and a rate of return standpoint, but the equity investment liked the interest-only loan better from both a NPV standpoint and a rate of return standpoint. So what can we take away from that? In this model, leverage helps us. So all the metrics get better with leverage. And if they do, then equity would prefer the most leverage, and therefore the interest-only loan, being able to put that lump sum payment off as long as possible is the most advantageous. There's a lot packed in this video. You might want to scan back through it once or twice. Hope you have a great day.